So this is part two of the five breakout chart examples video. In part one, I discussed about volume. One of my YouTube subscribers had asked me to discuss volume during that high volume rally, low volume consolidation, and high volume breakout. Okay. So I did a detailed discussion on how to analyze volume inside a confirmed stage two uptrend. If you watch that video, you will never feel confused about volume. Okay. In this video, which is part two, I want to show you the same five chart examples and I want to help you identify what are the things that are common in these five chart examples. See, what happens is when you study the past breakouts, you want to find what are the common characteristics that these stocks were displaying on the chart. Remember, I am still not discussing fundamentals, liquidity, comparative analysis. Okay, I am only focused on technical analysis in these five breakout chart example videos. Okay, so in these five charts, we will try to see what is common. The first thing you will notice in all of these five chart examples is the moving averages. The blue line, which is the 50-day moving average, is about the green line, which is the 150-day simple moving average, is about the red line, which is the 200-day simple moving average. Okay. And the price is above all the three moving averages. So notice blue, green, red, and the price above the three moving averages. So this is Tata Investment. This is IRFC, blue, green, red. This is ITI, blue, green, red. This is GRSC, blue, green, red. This is persistent, blue, green, red. Okay. So now you notice what is common in all of these stocks. By the way, all of these stocks went up nicely after they broke out, except for I think ITI, which after the breakout started falling. But do you notice the first common thing in all of these five charts? Now tell me, would you ever buy a stock which does not show you the blue, green, red? Chances are very low because now you have looked at past chart examples of breakout. These are only five. I encourage you to go back and check at least 100 or maybe 500 breakout chart examples and see whether it was displaying blue, green, red before the stock breakout. That's number one. Number two, I had already discussed in previous video how to identify point one in the base. So this is point one. So the candle which completes point one, you ignore that candle and you start counting from the next candle. So from this candle, let us count how many candles are there before the stock broke out. How many candles are there in the base? Okay. So start from here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and so on. So it has more than 10 candles. Okay. Next. So this is point one. So we will ignore this candle and we'll start counting from here, easily more than 10 candles. Here in this chart, we will ignore this candle. So we'll start counting from this, easily more than 10 candles. Here again, this is point number one. So start counting from here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. After 12 candles, it broke out. That means minimum 10 candles. Have a look at this. Ignore this point one. Start counting from here, easily 10 candles. Okay. So do you notice the second common factor in all of these five breakout chart examples? All of them had minimum 10 candles in the base after point one. So you ignore the candle which completes point one and start counting from the next candle. Okay. So you have the second common factor. Why 10 candles? Because 1 week has got 5 days. 1 week has got 5 candles. So 10 candles means 2 weeks. So you are giving the stock 2 weeks of time to consolidate, which is decent enough amount of time. People like William O'Neill would give 3 weeks to more than 3 weeks easily, but I prefer minimum 2 weeks of consolidation. I have seen a lot of stocks which consolidate for 2 weeks and shoot up like crazy. For example, GRSC, which you saw here, consolidated for 12 candles, 12 days. After that, it shot up 85% in less than 3 weeks. Okay, so minimum 10 candles. Then, what is the next common factor? The number of points inside the base. All of them have minimum 4 points inside the base. Now, you already know this model that I have taught. Okay, this diagram is something that I had created for myself. So point 1, point 2, point 3, point 4. If you have spent good amount of time on this channel, you already know how to mark these points in the base. But if you are new, I will do it for you. Have a look at this chart. Let me mark the points for you. You go from highest to lowest. Okay. Point 1, point 2, point 3, point 4, point 5, point 6. Next chart. Okay. This is point 1, point 2, point 3, point 4. Got minimum 4 points in the base. Here again, point 1, point 2, point 3, point 4, and here is point 5. Remember, point 5 is below point 3. Okay. Again, minimum 4 points in the base. Here, this has got 6 points in the base. If you notice, point 1, point 2, point 3, point 4, point 5, point 6. Okay. Next. Point 1. This is point 2. I think the base needs to be drawn correctly. Point 2, point 3, and point 4. The base should be like this. Okay. So have a look at all the 5 charts. How many points in the base? 6. That means minimum 4 points. Here, minimum 4 points. Here, 5 points in the base, which means minimum 4 points. Here, 6 points in the base, which means minimum 4 points. 4 points in the base. Did you find the third common factor? Minimum 4 points in the base. So what did we learn in this video? Blue, green, red, 10 candles, 4 points. Blue, green, red, 10 candles, 4 points. Repeat after me. Blue, green, red, 10 candles, 4 points. This is not rocket science. This is extremely simple. I cannot simplify this more than what I have done in this video. Just remember this simple thing. If retail investors or traders in India had just understood the power of blue, green, red, I would say at least 50,000 crore worth of losses could have been avoided when markets were in a downtrend or when markets were in a free fall, right? If you simply stick to stocks, or if you simply limit your research to stocks which are already showing blue, green, red, you are putting the odds in your favor. If you read Mark Minervini's book, he has already written in that book that 98% of all the leading stocks of the past were already in a confirmed stage 2 uptrend before they began their big price advance, which means before these stocks doubled, tripled, quadrupled, or even went up 10 times, before they did that, they already were showing blue, green, red. Okay. So why to even waste time looking for a stock which does not give you blue, green, red kind of moving average combination? It doesn't matter whether it is a blue chip, large cap, mid cap, small cap, doesn't matter. If it is not showing blue, green, red, I'm not interested. It's very simple. The 50-day has to be above the 150. The 150 has to be above the 200-day. I am putting the odds in my favor. So what is the moral of this video? What is the moral of the story? Blue, green, red, 10 candles, 4 points. These are the 3 basic things we look for as a qualifier. Now remember, just because it has got blue, green, red, 10 candles and 4 point doesn't mean you buy the stock. Okay. That's a qualifying criteria. That's a filtering criteria. Okay. It will help you reject more than 90% of stocks in the stock market. So first you have to learn the skill of rejection, then you have to learn the skill of selection. So first check for blue, green, red, 10 candles, 4 points in the base. Then you go to comparative analysis, fundamental analysis, liquidity analysis, market analysis as per our orange trading system. But this is non-negotiable. It has to be there. There are some criteria on which we can be lenient, okay, like EPS growth, sales growth, things like that. But blue, green, red, 10 candles, 4 points, this is the basics that I can teach you. You read any book written by William O'Neill, Mark Minervini, they may not talk about 10 candles or 4 points, but more or less they are discussing what I have discussed with you today. I have just made it more objective. In the books, it is more subjective. In this video, I have made it more objective so that it is easy for you to understand a particular base. In part 3 of this video series, we will go into details. I will talk about the yellow line and the closing price in the zones that they appear. I would also like to talk about the mother baby candle combination. If you notice in all the 5 charts, there is mother baby candle combination, which we will look at in part number 3 or maybe part number 4. But I want to make the best use of these 5 chart examples to bring value to you. These 5 breakout chart examples teach us a lot about how to look at a base, how to identify a base, and be ready when the stock is breaking out on high volume. Thank you so much.